Good afternoon, everyone. Thanks so much for joining us today. My name is Stephanie Creighton, and I'll be your host for today's webinar on Revenue Recognition Part 1, Contract Review and Identification of Performance Obligations. Before I introduce today's presenter, I'd like to go over some housekeeping items. Today's presentation will last about 45 minutes, and we will have time for questions at the end. The slides can be downloaded at www.wolfandco.com/webinars/2018. You have two options for audio today. You may dial in by phone or listen through your computer. Our audience will be muted during the session, so if you have any questions at any point, please send them in to me by using the questions box located on the webinar's control panel. I'd now like to give a brief background of the firm. Wolf & Company was established in 1911 and have 2 centuries of experience providing our clients with assurance, tax, business consulting, and risk management services. We have over 250 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. It's now my pleasure to introduce today's presenters, Scott Goodwin and Cecilia Ferret. Scott serves as a member of the firm and technology services team leader. Cecilia is an audit principal and software sector leader. Thank you both for presenting today, and I'll now hand the presentation over to Scott to get started.
Thanks for joining us, everyone. We have a lot to get through today, and I think we're probably going to have some questions, so I want to jump right in. But before we jump too far, just a couple of things about the session. So this session is very much tailored for software companies and SaaS companies specifically. Also, this session presumes at least a basic understanding of ASC 606 and the 5-step model. Finally, it's only designed to cover the first 2 steps in the 5-step model. So we have upcoming sessions that are going to cover the other 3 steps. So if you feel like you walked into the wrong class on the first day of college, I apologize for that. But here's the agenda that we have for the next 45 minutes. So Cecilia is going to talk us through some thoughts on adoption strategies and challenges. Then we're going to introduce you to the contract review process. Next, I'm going to take a deeper dive into the process for identifying performance obligations. And this is going to be very much focused on case studies and examples. And then finally, we're going to wrap up with hopefully some of your questions.
All right, thanks, Scott. So before we dig into strategies for contract review, we wanted to refresh on your choices for adoption. So I'm going to assume that the majority of the folks listening are privately held companies on a calendar year end and will be adopting as of January 1, 2019. So the full retrospective method means that in addition to your 2019 results being presented under 606, you would restate your 2018 financials to present them under topic 606 as well. So essentially, it would look as if 606 had always been applied and you would have comparative financial results. There are practical expedients when applying the full retrospective method, the most significant of which is that completed contracts, you do not need to, for contracts completed within the period, they begin and end within the same annual period, you do not need to revisit or restate those contracts. Then you would contrast this to the modified retrospective method. Under this method, you would make an adjustment to retained earnings as of January 1st, 2019 for the cumulative effect of adopting 606. Your 2018 financials are unchanged, and the cumulative adjustment shows up as a line item in your statement of stockholders' equity and within your cash flow statement as a non-cash item. So, if you choose the modified retrospective method, you're going to lack comparability to 2018. So you'd have some additional disclosure requirements, such as disclosing the impact of adoption on each financial statement line item. That would be disclosed in the footnotes. And in addition, there would be some qualitative disclosures so that the reader can really fully understand the impact of adoption. So as companies think about which method to use, probably one of the biggest considerations is comparability and how significantly revenue has changed as a result of applying 606. When looking at public company filings and early adopters that applied the full retrospective method, the CFOs said that when they chose to apply the full retrospective method, that was because they had a material impact on revenues and we're really looking at comparability for the end users. So there certainly could be other considerations for your company, but I wanted to share this to highlight that the conclusion on how to adopt could very well come down after you've written your white paper, which is your revenue recognition memo, and you have a full grasp of the impact of 606, before you determine what's the best way for your company to transition. So one of our public clients elected to early adopt, and in reflecting back on that experience, the single largest takeaway was it's really about the journey rather than the destination. So what do we mean by that? Well, I think it's probably human nature to want to skip ahead to the end of the model and to be able to make a conclusion about revenue recognition. No one likes uncertainty, and no one has more hours in the day to complete the analysis. But really, the process of moving through each step of the model and really documenting your conclusions, it's very important to fully understanding where you end up, even if where you end up at the end is not, overly material to your financial statements. So I really encourage you to take the time to come up with as comprehensive a white paper as you can. At the end, you'll feel more comfortable with 606. You'll be able to get buy-in on all the issues and potential questions from your management team, from your board, from your external auditors, and you'll really have a living document that you can use as a resource for addressing revenue recognition issues as they come up in the future. I think it's important that adoption is really only the beginning of 606, and it's going to be around for many years. So spending the time, investing the time, if you can, to really write down your conclusions and interpretations would be great. Another item that we learned is that you almost undoubtedly will come across one-off contracts that need to be analyzed. Or if you don't find it in your analysis, your auditor, as we have a keen ability to do, will probably randomly select that one-off contract for testing. So if you can minimize one-off contracts, that could be a huge win, because they take a long amount of time to thoroughly address, especially if they're not addressed in the work paper, in the white paper, excuse me. So how do you prevent this? Well, it comes down to contract controls and sales and marketing controls. So either you're making contracts uniform, or you're at least being alerted to when there are one-off contracts. So I'm going to touch on this more in a few slides when I talk about your transition team. So the last few points here discuss looking at public company filings. And that's recommended. Some companies did early adopt last year. The rest of the public companies are really early adopting in Q1 of this year, so their 10Qs will be out soon if they're not out already. So see what your industry is doing and leverage the work that they have done. You can glean a lot from your comparable public company filings. You won't be the only ones looking at those. I'm sure your investors will look at companies within your industry, and they may have questions on treatment and disclosures and why you are reaching the same conclusions as those in your industry, or why you're reaching different conclusions. So it's advised that you take a look at those other public company filings. So then moving beyond adoption methods and kind of getting back to the standard itself, we've put in the full model here just to remind us all that 606 is a principle-based standard, and really the FASB built 5 steps to help us all achieve that principle. But the key concept here is really we're recognizing revenue in order to depict the transferring of promises for the right to receive consideration, and breaking that down to even a shorter sentence. But in this webinar, we're really focused, as Scott said, on steps 1 and 2 of the model. That's identifying the contract and then identifying your performance obligations. And the remaining webinars will address other aspects of the model. So then moving on to step 1, what makes a sales contract for your company? For SaaS companies, which I assume most are, it's typically a straightforward process. There's going to be an annual subscription, a user agreement, a master services agreement, followed by SOWs. So it's usually not too hard for software companies to identify what their contract is. So we won't spend a lot of time on this particular step. What I'll emphasize here is that collectibility is now embedded within the first step of the process. Previously it was one of the 4 requirements. So collectibility is really an indicator of whether the contract has commercial substance. So it's critical to being able to move beyond step 1 is documenting how comfortable you are that collectibility is probable. And again, that's maybe less of a point for software companies, especially SaaS companies, where payment is often made at the beginning of the subscription. But I wanted to highlight this so that you don't kind of get stuck on step 1 if you can't reach that threshold. So then some strategies for contract review. So I don't think I'd be a good auditor if I didn't stress the need for you to document your process. So this is really in addition to the white paper. I know it's more work, but it's in addition to your white paper. We'd recommend that you have a separate transition memo. We found this especially helpful when our public companies were adopting. The transition memo documents, how you're transitioning to 606 and the different steps you took and why. Your auditor will definitely be looking for this, and it's really something that hopefully you're discussing with them as you move through the implementation process. So they're not seeing this at the end; they're involved with you throughout the implementation process, and it will become a great reference material to you, so that as you move forward, you remember why exactly you're making the decisions that you did. So defining the population. So as I noted earlier, there's a practical expedient over completed contracts. So you're really going to be focused on contracts that will be, essentially in process as of the adoption date, and then contracts that are likely to be signed in the year of adoption, so 2019. And we've put down a suggestion on sorting contracts by type. So the idea here is that you are breaking them down into manageable groups for analysis. So an example could be different types of licensing rights. So if you sell an on-premise solution to one customer segment, for example, your financial institution customers want an on-premise solution, and then other customers are happy with access to a SaaS platform. Those should be broken apart and looked at separately because they likely have different revenue recognition patterns. Or it could be I sell to certain customers, I sell an annual subscription, and to others I sell multi-year subscriptions. So those you might want to look at those separately. Other things to be aware of: pricing or billing patterns could be another way to segment the population. That could be helpful when you go to analyze contracts for material rights and variable consideration. Levels of services provided is another. Obviously, you're going to need to analyze those services to see if they are separate performance obligations. So the more you can group like services together, the easier the analysis will be. So think about your offerings and what type of software may be paired with customization or integration services, and if it makes sense to analyze those contracts separately as a result of differing promises made to the customer. Another group would be the one-off contracts that I highlighted earlier. These are things that don't fit in with the other categories. We often bend over backwards to assist our customers or to gain new ones. So think about what one-off contracts could be out there, and you'll need time, as I said previously, to really analyze these separately. One question that we frequently get is, how many contracts do I need to analyze? And I would say that really depends on the level of standardization and your confidence that everyone is following the standard contract. So we don't really have a direct answer for you on that. It's going to vary from company to company. But I would suggest, thinking about it, thinking through documenting the number of contracts that you've reviewed and why you chose that particular amount and how you're comfortable with that particular amount given the control environment. And you can also, of course, you're talking with your auditor, you can run that sample size by them as you go along to kind of get their feedback. Also, it's good to have a team working on this, a collaborative team. Think about who should be involved in the contract review. The CFO and the accounting manager, obviously, are going to be a part of the team. I would imagine the CFO taking a lead, writing down the white paper and the transition memo documentation. And the accounting manager may be performing more of the detailed review and bringing discussion items to the CFO. But in addition to the finance and accounting team, think beyond that. Think about including members of your sales team, your implementation team, and even your IT team. So why would you include these folks? Well, the sales team, because they're the ones negotiating the deals. They can help identify those one-off contracts. They can identify discounts being offered, different things that are usually on the table for negotiation, and it's also helpful for them to learn the impact of these negotiations and the impact of contract terms on revenue recognition. And if you do this in 2018, you may find that your controls or processes will be in place, maybe different for 2019 upon adoption. Your implementation team is important, especially if you have significant customization and integration services that help your assessment of performance obligations. Really dig into the details of what's being provided to the customer. And I'll add a point that as auditors, we frequently request to meet with implementation teams during the audit in order to verify the depth and nature of the services being provided to the customer. So it's great for the accounting and finance folks to also get ahead of that process. And IT folks, why would they be included? Well, I think that goes to disclosure and tracking. So think about how they can assist in gathering data points for you. And even if they're involved, they can even think about how to help you kind of automate some of the processes and controls going forward. Another point, which is often a challenge in smaller accounting and finance departments, is to think about the controls over contracts and uniformity in terms. Customization of contracts would non-customization of contracts leaves the door open to various variety in terms and cancellation terms and potentially material rights, other one-offs, just a lot of potential issues if there's not consistency. If consistency is achievable, that's great. If it's not realistic for one reason or another, then think about what safeguards you can put in place to capture the variability and ultimately its impact on revenue recognition. So before I pass it over to Scott to talk about performance obligations, a last point on timing and timeline. This is, it's a large project, and it's large enough that probably warrants an overall project timeline, especially if you're involving others within the organization. So give yourself the time, your sales team, your board, your external auditors, time to move through this analysis with you. It's also likely going to be an iterative process. As you write the white paper and review contracts, you'll find things that cause you to revisit the guidance, things that you want to discuss with your CPA and others within the organization. And you may ultimately go back and revisit parts of your white paper. So give yourself the time to do those things. And lastly, based upon an annual reporting requirements, if you have to finalize 2019 and you're essentially going to finalize 2019 in early 2020, you likely have until the end of 2019 to apply the standard to go back and apply it to all of 2019. But to the extent that you can get started this year and do the analysis, you can then truly apply the impact of 606 as of January 1, 2019, and you'll just make your life that much easier. So Scott, can I hand it over to you to talk through performance?
Can. Thank you. Step 1 completed. Time to move on to step 2. So Cecilia briefly mentioned or referred to licenses of IP. And before we get too deep into the performance identification process, there's a threshold question you need to answer, and that is, do you have a license of IP? So you're probably familiar with the current guidance related to when a hosted arrangement falls under the current software RevRec rules, the dreaded 985, and when it falls under the general RevRec rules, the 606, and is accounted for as a service contract or a subscription. So the good news is that most of that guidance has been carried forward to 606. So if you weren't considered to be licensing software under the old rules, you probably won't be under the new rules either. If you sell an on-premise, perpetual, or term license, anything like that, you'll definitely need to evaluate whether you're licensing IP. It's a whole separate set of guidance around licenses of IP. So we're going to move forward assuming you're a SaaS company and not licensing IP. So the definition of a performance obligation, Cecilia showed the 5-step model a few slides back, and the objective in step 2 is really to identify the performance obligations in the contract with the customer. So we need to do a quick refresher on what a performance obligation, and I may slip and say PO, and I'm referring to a performance obligation and not a purchase order. So what are we really looking for here? And a performance obligation is a promise to deliver something to the customer, and that something is either a good or service that is distinct, or a series of distinct goods or services that are substantially the same and have the same pattern of transfer. So a couple of things to note there. First of all, there are 2 very specific types of promises that can be performance obligations. Second of all, both of those contain this concept of distinct. So what is distinct? It's a 2-pronged test. The first one is the customer can benefit from the good or service on its own or with other readily available resources. That's also referred to as capable of being distinct. It's roughly equivalent to what we now refer to as standalone value, the standalone value concept under current GAAP. The second prong is separately identifiable from other goods or services in the contract. This is also referred to as distinct within the context of the contract. So these are important concepts, and what we're going to do for the remainder of this session is really look at how they operate in specific situations. So speaking of specific situations, let's dive right in. So this first example is a 3-part question. So we're diving a little bit into the deep end of the pool, but here we go. So in this situation, you have entered into a subscription agreement with a customer. You provide basic, I'll refer to them as PCS services, maintenance and support. That may include phone support, and unspecified upgrades as they become available. So for purposes of the remainder of this discussion, I'm just going to refer to the maintenance and support piece as being everything other than the unspecified upgrades. So question 1, how would you go about evaluating an arrangement like this and the promises in here? So clearly there are 3 promises in here. There's the obligation to deliver the SaaS software, there's the maintenance and support, and there's the unspecified upgrade. And your first step is always to consider what is the nature of the promise. And when you look at a couple of these, you will see that they have some particular attributes. So what do you as the seller have to do in order to fulfill these promises, particularly the maintenance and support and the unspecified upgrades? You may have one customer who uses the platform 24 hours a day, 7 days a week. You may have a customer who calls the support line every day. You may have a customer who never uses the platform or calls the support line. And you may provide 10 upgrades. You may provide no upgrades over the subscription period. So, but you've definitely promised to do something during that period. So this is why the FASB created the concept of a stand-ready obligation, because without this concept, it would be hard to take promises like this and fit them into the performance obligation definition. So why is this distinction even important? You told us at the outset, what we're trying to do is identify performance obligations. So why does it really matter what kind of performance obligations these are? Well, it becomes very important when you start to look at how the revenue is going to get recognized, point in time, over time. Those are probably phrases that you're familiar with. Step 5. So how you define and determine the performance obligations is going to have a very big impact as to how the revenue actually gets recognized in step 5. So let's look at these promises individually and see how they look in relation to the stand-ready. Let's see if they look like stand-ready obligations. So the maintenance and support, in order to fulfill that, you're required to maintain a certain maintenance and support infrastructure. regardless of how much the customer may or may not use it. The customer's got the ability to access this maintenance and support when and as needed. So typically a maintenance and support commitment like this, promise like this, would be considered a stand-ready obligation. The unspecified upgrades, really the customer doesn't benefit from any specific upgrade because you haven't promised one. What they are benefiting from is the ability to receive upgrades if they're made. There's generally an undefined number of upgrades during the period that the customer is eligible to receive. So the unspecified upgrades would also be a stand-ready obligation. So question 2, assuming these are stand-ready obligations, how does this conclusion impact our performance obligation assessment? So here we are, we've identified 2 promises focusing on the maintenance, the support, and the upgrades. They represent stand-ready obligations. You still need to figure out whether these meet the requirements of a performance obligation. So they definitely don't represent a promise to deliver a distinct good or service. They just don't fit that category. So the next question is, do the stand-ready obligations represent a performance to deliver a series of distinct goods or services? There's a whole body of guidance. This is referred to as series guidance. So in order to do that evaluation, particularly for a service promise as opposed to a product, the series guidance requires that there are multiple time periods within the obligation period that are distinct from each other and substantially the same. So you'll note that both of those concepts, the distinct and the substantially the same, those are included in the definition of a performance obligation. So the other 2 are, they're satisfied over time, and that's based on the overtime revenue recognition criteria later in the revenue recognition guidance. And then finally, they have the same pattern of transfer to the customer. Now, you may have picked up on the term over time. That comes from 10-25-27. And that is really a critical part of step 5. So it's somewhat interesting to note that in step 2, in identifying the performance obligation, the guidance requires you to go out and look to see if this promise would be satisfied over time in step 5. So let's look at the requirements specific to this situation. The time periods are distinct from each other. So each time period, whether that's a day, a week, or a month, that the entity stands ready to perform, it's capable of being distinct. The entity's promise to deliver the upgrades and enhancements, it's separately identifiable. The time periods are substantially the same, so even though what you do in any particular time period related to either the maintenance and support or the upgrades may differ, the nature of your promise to the customer is really the same regardless of whether you're in day 1, week 1, or day 365. Satisfied over time. So with a stand-ready obligation, the customer receives and consumes the benefit from the maintenance and support and the upgrade rights throughout the obligation period. So that is almost verbatim from the step 5 guidance. Has the same pattern of transfer to the customer. So for each distinct service period, again, that's however you want to define it, a day, a week, a month, you would use the same measure of progress. So the ultimate conclusion here is that these promises are stand-ready obligations that do meet the series guidance requirements. So finally, in step 3, if we have met the requirements of the series guidance, would each of these elements represent a separate performance obligation? And this is really getting at the question of whether the individual promises are distinct. So the answer, yes, generally these types of services will be determined to be distinct. Why? Let's look at the 2-pronged requirements of being distinct. Are they capable of being distinct? Yes, because the customer receives the benefit from either each service, either the maintenance and support and the upgrade rights, with the SaaS product, which is readily available resource. Distinct within the context of the contract. Generally, they're individually specified in the contract, and they're not inputs to a combined output. You're not actually selling an integrated service. And finally, you could provide either of these services regardless of whether you provided the other service or the SaaS product. So in summary, this was really an exercise in moving through the performance obligation analysis process. You could take this same process and apply it to a lot of different fact sets, and would hopefully come out with the right answer on performance obligations.
Okay, so in our next example, your subscription agreement allows a customer to cancel their subscription at any time within 30 days notice and receive a refund for any portion of the subscription period that has not expired. So the question here is, does the contractual obligation to potentially provide a refund represent a performance obligation? So Scott, in reading the question, it doesn't sound like to me it would be a performance obligation, because when I think back to the definition of a performance obligation, there's no promise of delivery of a good or service. So that's my initial thought. But
right, no, you're right. You're on the right track. The answer is no. These types of refund rates are generally not performance obligations. The codification is pretty clear on that. If you want to check me on it, you can look up 10-55-24. And as you point out, Cecilia, that answer kind of makes sense, because this type of provision, it doesn't sound like a performance obligation. Just doesn't sound like the definition of a performance obligation. So that's the good news. The bad news is that provisions like this of refund rights could potentially be treated as variable consideration in step 3. And although we don't want to get too far ahead of ourselves here, ultimately, I don't think you'd end up with significantly different accounting than you have now. Similarly to the current guidance, if you can reasonably estimate the refunds, you estimate them and record them up front, and you would end up under 606 with generally consistent accounting treatment than what you're getting now. Okay, so you enter into a contract to provide a customer with access to your SaaS product for 3 years. In 6 months, you intend to begin offering an additional add-on product. You offer the customer a 50% discount on the first 3-year SaaS agreement it enters into for this new product. How would you evaluate this? So at first glance, that right to a discount on a future product doesn't sound like a performance obligation. It's not a promise to deliver a distinct good or service, and it's certainly not a series of distinct goods or services. The customers may not ever take advantage of it. So this is why the codification introduces the concept of a material right, and they define that as a promise to deliver goods or services in the future, which is embedded in a current contract that the customer would not receive without entering into the contract. And all material rights are separate performance obligations. So to go back to this situation, in this case, the right to a discount on a future product would most likely represent a material right and therefore a performance obligation, since the customer only receives the discount by entering into this contract. So there's a presumption that this material right is part of what the customer bargained for and was buying. Therefore, it needs accounting treatment and recognition.
Yeah, and Scott, before we move on, I'll just highlight that I think it's a great question and a great example of why it's a good idea to have a member of your sales team on your transition team to evaluate your transition to 606, so that they can be aware of when they're negotiating these deals, if they're negotiating discounts like this, the impact it has on revenue recognition, and then flag any of these deals to your accounting team.
Right.
All right, so I'm going to read the next example. So you enter into a contract to provide a customer with access to your SaaS product for 3 years. As part of the contract, you agree to set up their user interface that the customer will need to access the SaaS application. And you will also perform data conversion and data migration activities for the customer to configure and move its data from the customer's legacy on-premise solution to your SaaS application. You will also provide training to certain customer personnel on the use of the SaaS application. So how should you evaluate these various upfront services? So Scott, this is a pretty meaty one.
Yeah, this is. So this arrangement or some subset of it probably doesn't sound unfamiliar to many of you, but the first thing I'll note is that these are all upfront services, meaning that they essentially all take place before the customer starts using the SaaS platform. So the first thing you need to do is determine if any of these services are administrative tasks or setup activities as opposed to a promised good or service. Now, a setup activity provides no incremental benefit to the customer beyond what they would receive from the SaaS product alone. So to say that another way, there are activities that are necessary for the customer to begin using and benefiting from the software. Those are setup or administrative tasks. On the other hand, if the promised good or service provides some benefit beyond solely being able to access the software, then it is a promised good or service. If the entity that's providing the service so just to be explicit about setup activities and administrative activities, if you conclude that you have certain of these activities, they're given no revenue recognition treatment since they're not performance obligations. They're essentially ignored. So let's look at these items individually. The first one is the setup of the user interface. So you're probably going to conclude that creating the user interface is a setup activity rather than a promised service to the customer. It really is providing no incremental benefit. It simply allows them to access and use the hosted application. Data conversion, migration, and training, you're probably going to conclude that these are promised services. So these are services that provide the customer with incremental benefit beyond simply being able to access the application. The data conversion and migration activities you're performing would otherwise be performed by the customer themselves or potentially by another service provider. And even though it would be inefficient, the customer would probably be able to use your hosted solution for new transactions, even if they weren't able to convert and migrate over the old data. And then finally, the training of the customer's personnel will certainly permit or hopefully permit the customer to effectively use the application. But similar to the data conversion and migration, your training activities are doing more than simply setting up or enabling the customer to access the SaaS platform. So this was really a question about distinguishing setup activities from promised goods or services. So this is a long one, so I'm going to let you take a read through it, but it's a very similar arrangement to what we just went through. You just have a little bit more detail about the nature of the services, how complex they are, and who can perform them. So I'll just give you a couple minutes to scan through that. Okay, so in the last question, we essentially concluded that the services were promised services other than the building of the interfaces. In this case, we're given a little bit more information, so we're told that the services related to building the interfaces is not complex, and that other vendors provide them. So with those two facts in mind, I think you can conclude here that even the interfaces appear to be promised services rather than setup activities. So now the question becomes, are they distinct? So remember, this is a requirement in order for any promised good or service to be a performance obligation. So let's start with capable of being distinct. The hosted solution is sold separately regularly when customers renew, so they can clearly benefit from the SaaS on its own, so it is capable of being distinct. And then thinking about all the services individually, the customer can benefit from each of them together with readily available resources, that is the hosted solution. So in this case, it appears that each promise appears to be capable of being distinct, both the SaaS and all of the services. So how about distinct within the context of the contract? So the SaaS in each service is appears to be separately identifiable. The customer could get the services from other providers. They could perform the services themselves. And your obligation to perform the services isn't integral to the customer's ability to benefit from the hosted solution. So the conclusion here is that the hosted solution and each of the services is a separate performance obligation. Now, I just told you that this fairly typical hosted arrangement consists of at least 5 performance obligations: hosted software, interfaces, data conversion, data migration, and training. So that should be enough to make your head explode due to the complexity that would come moving through steps 3, 4, and 5 with 5 or more performance obligations. Well, the FASB thought of this and has provided some relief. 606 specifically permits that if there are multiple performance obligations, they can be accounted for as a single performance obligation if the accounting outcome would be the same. So these are all upfront services. If you typically provide all of these services in, say, a 30-day period or a 90-day period, then there would be no reason to consider each of the services individually in steps 3, 4, and 5. You could kind of put them all together. The accounting outcome wouldn't be any different. They would all be recognized over that 30-day or 3-month period. So that will bring a lot of will make steps 3, 4, and 5 much easier and more practical to apply. So this situation just adds on top of the prior example. So there's some additional facts here. So you have also agreed to provide some additional functionality to the existing hosted application. You are going to provide that functionality before the customer goes live, and you do not regularly sell these customized services separately. So in this case, you determine that the customization is a promised good or service. It provides incremental benefit. So it doesn't sound like a setup activity. It sounds like a promised good or service. So now you're moving through your performance obligation evaluation. But in this case, the customer can't benefit from the customization, and you don't sell a customized SaaS offering on its own. So therefore, it doesn't sound like it's capable of being distinct. So you failed sort of prong 1 of the is it distinct test. So it is not a performance obligation. So what would you do in this case? Because you certainly have to perform those customization services. So in this case, you'd combine the hosted solution with the customization into a single performance obligation. In that case, if you considered those together, the hosted software and the customization would be distinct, and together would be a performance obligation, and you'd move through the rest of the revenue recognition guidance. So building again on that fact set, same as the prior question, except you regularly provide these customization services separately. So what does that do to your answer? So with this additional fact, you probably would conclude that the customer can benefit from the customization services on their own since you sell them separately. Therefore, you can conclude that the customization services are capable of being distinct. But I've already told you, I think several times, that's only one part of the requirement to be distinct. So how about it being separately identifiable, or in other words, distinct within the context of the contract? And the answer here is probably not. It really gets back to what is the nature of the promise. And your promise is to provide a customized SaaS offering. It's not to provide a SaaS offering and some customization. remember, it's specified that these customization services are going to take place before the customer goes live. So even with this additional fact, the customization is probably not going to be a separate performance obligation and would still have to be combined with the SaaS. And this example really reinforces the two-part nature of the distinct concept, and it reinforces the need to never lose sight of what is the nature of your promise. If there's anything you ever have to go back to, that would be the overriding concept I would go back to. Okay, so as part of the subscription agreement, you agree to add some specific new functionality. So this is taking a pared down example similar to the last one, but we're going to take it a slightly different direction. And that direction is going to be, how does this fact set, the outcome of this fact set differs based on whether you are, or how you're delivering your solution, whether you're a SaaS, whether you're an on-premise license, or some sort of hosted. So in a licensing situation where you did deliver the software, you would actually have to deliver additional code in order to supply this new functionality or these additional features. Presumably the customer has possession of your existing code, and when you've developed the new features or functionality, you would deliver additional code. Whereas in a SaaS situation, presumably the customer is already accessing your software. So again, what is the nature of your promise in a SaaS situation? Is it an additional promise service to the customer, or is it just part of the overall promise to provide the SaaS? Would this type of additional functionality just be part of what the customer would expect overall from your SaaS product? So what kinds of things would you look at when you're looking at your commitments to add these features and functionality? So is the customer accessing the software on a one-to-one or single tenant basis? So in this case, that customer would generally be the only customer benefiting from this additional functionality and features. So that would be an indicator that this features and functionality being a promised good or service to that customer. This would probably not be the case if it were a true SaaS model where it was not a one-to-one or single tenant basis, it was one-to-many. Does the added feature or functionality provide independent value to the customer? So are these features discrete and new? If they are, that's an indicator that these features or functionality are a promised good or service. On the other hand, if it's a little bit more subtle tweaks, minor improvements, look and feel kind of stuff, then it's probably not a promised feature. And then finally, do you intend to sell this new feature or functionality separately? Are you really developing a new module or an add-on product? If so, you've probably got a promised service. If this is more part of your ongoing development process, it may not be a promised service. So the lesson here is really that in order to get to the right 606 accounting treatment, you really do need to understand what's going on technologically. So I'm going to pause there, do a time check. So it seems like we're doing pretty well on time, but we probably should look to questions. So let's see.
Okay. It looks like we have just a couple that came through.
Okay.
So I'll read the first one here. So if I happen to sell an on-premise software, any big things we should know about the license of IP guidance? So yeah, we touched on it very briefly here, and we are planning to have one of our sessions really do a deeper dive on license of IP. But I guess I'll highlight a couple things to think about. So the license of IP, under that guidance, there are really two types of licenses. So if you fall under the license of IP guidance, again, that's going to be like your on-premise solution. You're going to be a functional or symbolic license, and software is going to be the functional license. And the difference here is that functional licenses are recognized at a point in time versus symbolic licenses are recognized over time. So when you deliver, essentially when you deliver that license, you've got point in time revenue recognition. So this gets back, Scott, to the idea that BSOE is dead, right? So so the good news here for on-prem solutions is that you're likely to accelerate some of your revenue recognition from how you were recognizing in 605. Anything else to add there, Scott?
No, I think that covered it really well. Thanks.
Another one here. So we've heard you identify a whole bunch of additional performance obligations today. Ultimately, what is this going to mean for us?
Right. Yeah, I think that's a fair observation that we did identify a whole bunch of additional performance obligations. But I think if we were to walk through all 5 steps with an example, you might see that although you identify a number of performance obligations in step 2, ultimately the revenue recognition for them will be aggregated or combined such that it really doesn't, the identification of those performance obligations doesn't ultimately end up having a significant impact on the revenue recognition. Now, I will caveat that by saying I don't think that relieves you of the obligation to go through a robust analysis of your performance obligations, because I don't think you can reach those conclusions as to, where can you aggregate, will this change the pattern or timing of revenue recognition until you've done that comprehensive performance obligation review.
Okay, read another one here. So I sell a multi-year subscription where the customer pays annually. How would that be handled? So I guess a typical auditor answer would be it's going to depend on the terms of the subscription itself. So the first thing that comes to my mind when I think about a multi-year SaaS subscription would be, are there any cancellation rights or termination provisions within that multi-year agreement? If it's, say, a 3-year deal and there is no provision for cancellation, then I'd say you likely have a 3-year subscription. If there's a termination right and the customer can terminate without any penalty, then you likely have a 1-year subscription that's renewing and not truly a 3-year subscription. And then a third option might be that there are termination rights, but there's a significant penalty that your customer would have to pay to terminate that arrangement. And if that was a really substantial penalty, then you would probably be back to having a multi-year subscription. And so I think the thing here is to focus on the termination rights, and then it's less on the billing pattern and more on the rights as they're defined within the contract.
Right, and that's I'll just piggyback on the last thing you said about the billing rights, which is it's really important that you move sequentially through the process. That when you figure out when you have a contract with a customer, that you carry forward that into step 2. Step 2, you're only identifying performance obligations in that contract with the customer. So you're really not even in step 2. You're really not even thinking about billing terms or those kind of things. So when you're looking at performance obligations, it's kind of without regard to the timing of payment. That really comes in step 3. So we had a question about whether we could give an example of a white paper, and I think that's a good question and a fair question, and we'll have to give that some thought, because obviously the ones we have now are client specific and very client specific. So we'd have to figure out a way if we could sort of sanitize those a little bit, but maybe we could talk to overall structure of that memo. And Cecilia, I don't know if you have any thoughts on it, but again, I think the best white papers that we see really do follow the 5-step model. And it's picking up on what Cecilia said about breaking the customers down into sort of categories or types that share similarities and working through each of the 5 steps. for those. I mean, those are the best memos that we've seen.
Jim?
Anything else on that?
No, I agree with what you said. I'm trying to think, I just think following the overall structure of the model is recommended, and then kind of going by here's our scenario, and then the issue, and then if there's relative very pertinent guidance, just copying and pasting in that guidance as you make your conclusion, so that the codification is right there to support any conclusions or analysis you have. It's also nice to have in the white paper.
Right. And then just be explicit in each step what your conclusions are. We've read white papers where they explained, these are the types of arrangements we enter into with customers and, purchase orders, and we got this and we've got that. But at the end of the day, it wasn't clear to me exactly where they ended up on, well, when do you have a legally enforceable right? So make sure at each step you are explicit, because that's going to carry over into the remaining steps. And the other thing I would say is that your memo, you're not going to sit down and write your memo from step 1 to step 5. You're going to start writing your memo. You're going to come up with some questions, which is going to send you back to the codification, which is going to send you back to your customer agreements and other documents, back to your memo, back to the codification, back to your customer agreements.
So we have 2 more questions. So the first being, talk to me about renewals. What are the issues, if any?
Well, it's an issue if they don't renew, but I guess that's not an accounting issue. So renewals, renewals generally aren't that significant an issue, at least through step 2. The only thing I would point to would be significant differences between a renewal rate or price and an initial rate or price. So if you have, a 3-year subscription that you charge $100,000 for the first period, and then charge $200,000 for the following period, that's not necessarily a problem. But if you are selling in that first period in conjunction with the 3-year SaaS other services, where you have to go through an allocation of the transaction price to various performance obligations, and you need to estimate your selling price, that renewal rate is probably going to reflect on that, because you will then be selling your SaaS on a standalone basis, and that will be a very strong indicator of what your estimated selling price is. And similarly, if the price is half of what you charge initially, that could be problematic also. Anything else on renewals, Cecilia?
No, I don't think. I'll go to our last and final question. This might be a nice lead into our last slide here, but when will there be a webinar on steps 3 to 5? So yes, we will be covering steps 3 to 5. I don't know if it's on our last slide here, Scott. Upcoming webinars. So we broke this into a 4-part series, hoping to do a little bit deeper dive on each of the steps. So we will be covering the remainder of the steps, and our next webinar is on Thursday, May 22nd, and it's going to be covering steps 3 and 4, so variable consideration and allocating the transaction price. And then I think we can also follow up with emails on the remaining webinars and what those topics are.
Right, and we'll be doing the same sort of email outreach for each of the next 3 sessions.
Okay.
Thanks, Scott and Cecilia. So it looks like our time is up. If you have any questions following the conclusion of this webinar, please reach out to Scott or Cecilia directly. Their contact information is listed on the current slide. Copies of today's presentation are available at www.wolfandco.com/webinars/2018. We will also be posting a recording of this presentation to the same web address later on today. And as Scott and Cecilia mentioned, this is a webinar, part of a 4-series session. Part 2 will take place on Thursday, May 22nd at 10 a.m., which is on the topic of variable consideration and allocating the transaction price, steps 3 and 4. And immediately following the conclusion of this webinar, you'll have the opportunity to complete a survey. As always, we appreciate your feedback so that we can continue to improve our webinar program. Thank you so much for attending today, and we look forward to your participation in future webinars. Have a great afternoon, everyone.